Going on, YouTube Nation? This is Start Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Tomorrow, I'm pretty sure that's TSLY, CONY, and NBDY day for me, so I'll reveal to you my passive income I earn for them. But I really want to go over Medical Properties Trust, MPW stock. A lot of negative attention. Now, I did own them and sold them. I'm going to go over some pros and cons of them, and there may still be some hope for them. So I want to go over this. There's a lot of controversy with them. There's a lot of negative energy, but a lot of people are capitalizing on them. I'll kind of give you my thoughts on what I'm going to do with them right now, the risks with them, and some positives with them. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. Let's check MPW out right now. The Medical Properties Trust, and I'm going to start since inception. They're sitting at $3.39. They took a huge, massive dip. So since inception, they're down 69.18%. Now, these guys are a big real estate investment trust. I'm going to go over that. Sitting at $3.39. I'm going to repeat that again. Average volume 21.76 million. The market cap is 2.03 billion US dollars. Year range is $3.38 to $14. Day range is $3.38 to $3.65. Look at that drop. $14 at one point. The year range. And now its previous close is $3.55. So let's look a little bit more into them. So I'm on investorplace.com, and here's the question. Why is Medical Properties Trust stock down 31%? This is 3 days ago. So it's falling on plans to reclaim unpaid rent. This has it reaching an agreement with Steward Healthcare System. The repayment will start in first quarter of 2024. So that's one thing that's going on. So a few things right here. So Medical Properties Trust stock is falling on Friday after the company outlined a plan to regain late rent and loan obligations. I'm sorry, I have like a cold going on. From Steward Healthcare System. Medical Properties Trust notes that Steward Healthcare System has been struggling to pay its rent and has instead only been making partial monthly payments. That has its current unpaid rent sitting at $50 million. This Medical Properties Trust and Steward working together on a plan that would allow the later to pay back the rent it owns. Medical Properties Trust is also taking actions to reduce its exposure to Steward Healthcare System as these rent issues. So the details on the plan. Part of these plans include a new $60 million bridge loan backed by all Medical Properties Trust existing collateral, adding to the new second liens on the Steward Healthcare System's managed care business. These liens will also cover Medical Properties Trust $215 million of transaction-specific and working capital loans on Steward Healthcare System. Right here to go along with this, Medical Properties Trust has agreed to defer unpaid rent and tapering of 2024 unpaid rent to $55 million. It expects partial cash payments from Steward to start again in February with a $9 million repayment in the first quarter. That should be followed by a $44 million payment in the second quarter. So MPW was down 31% Friday morning. I'm going to go a little bit more into Medical Properties Trust. Now, the one thing they have going for them, I'm going to start going with the positives. That was the negatives. The one thing that really hurt them with the negatives, I'm going to be straightforward with you. And again, this is not financial advice, but this is things that I've seen just working in the healthcare field as a nurse and hopefully future nurse practitioner. I'm going to go over their facilities and I'm going to explain to you some issues that happen. And this happened everywhere because of the pandemic. So they're in 10 countries. So they have behavioral health facilities, inpatient rehabilitation hospitals, long-term acute care hospitals, freestanding ER urgent care facilities, other 12.8% in general acute care hospitals. So right here, just looking at some stuff, inpatient rehabilitation hospitals, long-term acute care hospitals. So right here, general acute care hospitals, they're at 194. So they have for surgery, acute medical conditions, injuries, usually short-term stays. Long-term acute care hospitals, so that's one issue as well that I see. Behavioral health and inpatient rehabilitation. So this is a large part of their portfolio, the inpatient rehabilitation. The problem with this was with a lot of these places when the pandemic hit. I mean, they're big. I mean, 10 countries, they're across, I mean, they're in multiple continents, okay? So 31 US states, 7 European countries, and South America. So that's one thing that they have going for them is they're big. So the problem was, and I'm going to be honest with you, during the pandemic, first of all, people need long-term rehabilitation hospitals. There's a rise of strokes, amputations, diabetes, heart attacks. People need that. Behavioral health is a big thing as well. So mental health. When the pandemic hit, mental health facilities were taking a huge hit, as well as inpatient rehabilitation hospitals, long-term acute care hospitals. People did not want to go inside the ER, which was another issue. So long-term facilities, people were scared they would come in, and then the issue is they were worried about getting COVID. So nobody wanted to go in the hospital. Nobody wanted. I'm telling you, the hospitals were empty. Um, my step down unit was very busy. I would float to the a lot of the COVID units during the pandemic, but people were getting called off. It was crazy. They were like people that were ER nurse practitioners at certain hospitals, like downtown in Northeast Ohio, where it's usually busy. They were looking for like temporary work, so they were working in our hospital trying to help out and stuff. So it was kind of crazy because of that. So surgeries weren't going on as well. So the problem is during the pandemic, when surgeries weren't going on, long-term care facilities and acute care facilities for surgeries and stuff, fractures and everything, and just people that need like knee surgeries, hip surgeries, that wasn't going on for a few months. So that put everything back. So these guys were already fighting some debt issues based on what I've read. You guys can correct me if I'm wrong. Now they're still trying to like rebound from all this stuff that happened a long time ago. So I'm going to go over a few more things. Just looking at their operators, okay, Stewart Health Center, they're going through a lot of problems, okay? And I'm going to tell you, to be honest with you, healthcare is the most poorly run business. I mean, this is why acquisitions are happening between hospitals. This is why hospitals are closing. They're just not funded well. And don't get me started on the reimbursement. And, um, you know, it's like you go in the hospital and you get reimbursed on patient satisfaction scores. So that's another issue. You're not getting reimbursed the best because somebody's not happy that the omelet tastes bad, and then they give you a bad rating and you don't get reimbursed. That's part of the healthcare plan that came out. So that's a few problems. Now their portfolio composition is not too bad. Texas is a big one. United States is a big one. Eventually, I think they will come back. Okay, but right now I'm sitting back. There's actually a risk, okay, of a potential, and this could happen. They may have to do a reverse stock split. That can happen. They are just tanking. Now, a lot of people are capitalizing. I mean, it wouldn't hurt throw some play money in. I mean, I thought about it, just throw in like 300, see what happens or something, but maybe next month I'm going to start my travel position again, so I have some extra money to maybe play around with. Um, but right now I'm just sitting back right now, and I'm going to go over a few more things that are a little bit of red flags. I'm going to go over the recent quarterly financials. I'll also go over the other yearly financials of them. So their December 2022, the revenue quarterly, 387.68 million. That was down 6.85%. March 2023, it was at 362.46 million. Quarterly is down 13.11%. Then in June 2023, the revenue was 352.42 million. That was down 15.08%. Then in September, it was 318.14 million. That was down 12.56%. So they are taking a big hit. But again, the one positive for them is they're big. They are a pretty big real estate investment trust. That is one thing that they have going for them. They're a specialized real estate investment trust in the medical field. So that is one thing. They're a little bit specialized, which kind of helps them. I'm going to go over a few more things. So studying their trends over the years, okay, this is annually in millions US dollars, 2015, 441, 2016, 541, 2017, 704, 2018, 784, 2019, 854, 2020, 1,249, 2021, 1,544, and you're seeing a little bit of a difference in 2022. It went down 1,542. So, but looking at its previous history, there has been some increase. There's been an increase in the revenue. So that is still bonus points for them. So they're still, this is why I'm still watching them and closely watching them. Don't quote me on this, but a little bit of play money won't hurt for that. So that's one thing that I may do, may not do, but I'm closely watching. There's some positive numbers going up and the stock price starts jumping up. Can happen. So, again, you have to do your due diligence, do your research on stuff, but I'm just showing you some positives for MPW. So I'll show a few more things. So one thing I like to do is go over the FFO growth. And FFO's extremely important with real estate investment trusts. So the 5-year CAGR, 18%. 3-year CAGR, not mentioned. Okay, latest 12 months, negative 18.3%. So that's a big problem. But again, I went over a lot of positives. They are bigger. They are well diversified. There's not a lot of very good medical REITs out there. They still have a shot. So that's one thing that's important with the FFO. So we have to be very careful with our investments, of course, because you can lose money or you can gain money. But I like dividend growth, and the FFO growth is not good. And you'll see the dividend history real quick. So I'm on Zacks.com, and I'm going to show you the dividend trends. So 2009, it was 20 cents quarterly dividend. Finally, at 2014, it jumped to 21 cents. Then in 2015, it jumped to 22 cents. And then 2016, 23 cents. 2017, 24 cents. 2018, 25 cents. 2019, 26 cents. Then in 2020, 27 cents. This is when they started getting a hit a little bit. 2021, 28 cents. 2022, 29 cents. And then they were stagnant at 29 cents. And then here's the cut right here in 2023. So you're seeing a dividend growth in 5 years, negative 3.85%. They have a high dividend yield of 16.90%. There's still red flags. Again, there's a risk of a reverse stock split. There's a risk of a dividend cut. They're going through some rocky stuff right now. There's a lot more potential, and I see a lot more potential with them as compared to Walgreens, because there's a lot of competition with pharmaceutical companies, and I don't know if Walgreens can keep up. They just cut their dividend. But this is a very specialized REIT, so this is one I haven't given up on. I am not putting any play money in them, but this is something that does have a chance of a comeback, and I'm closely watching their revenue trends, their FFO. Things start looking better, I may rebuy them. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Post in the comment section. Are you taking the risk? Or are you pulling out? So take care and have a good one. And I'm going to jump to my disclaimer. So as a reminder, this is a disclaimer. Do not use this YouTube channel for any form of financial advice. I do not own Medical Properties Trust. And again, it is best to seek financial advice from a financial advisor or somebody that is certified to give financial advice. Investing is a big risk. You can gain money, you can lose money. I'm very transparent with my buys. A lot of the stocks that I own and I say I'm buying, I buy. And there's got to be a good reason for me to sell them. But right now, they're very attractive for me. This one is not attractive right now, but I'm closely watching Medical Properties Trust. Remember, investing, big risk. You can gain money, can lose money. So just be aware of that. So make sure you do your due diligence in investing. Any form of investment, REITs, stocks, ETFs, crypto, there's always a risk of losing money. So just be aware of that and do your due diligence. Take care and have a great Monday.